Hi, today we are going to review the Department of Labor's new PTE 2022-02 rule, the Prohibited Transaction Exemption Rule. And just a very general overview of what this rule regards. It's being allowed to receive compensation for the advice of rolling over a qualified plan, such as a 401k or an IRA, either of those two, an IRA. Currently, the way the ERISA rules read, it is prohibited to be compensated for that recommendation. So there have been exemptions in the past, and the Department of Labor just recently updated those exemptions and they've expanded upon them. So we're going to talk about them today. The rule is currently in effect, part of it, and that's the disclosure part of it. And we have been adhering to the disclosure part of the PTE 2022-02 simply by adhering to Reg BI. So with Reg BI, we've had to provide our clients with certain disclosures. That includes Form CRS, the firm's disclosure, and your personal disclosure. So simply by adhering to Reg BI, we've adhered to the first rollout of PTE 2022-02. The second part of that is now the documentation part of the rule, and that becomes effective July 1st of 2022. So we will get started on reviewing that. There's going to be a lot of redundancy throughout this PowerPoint. I wanted to, and that's intentional because I feel like there's so much information here that hearing it more than once is important. When this video is over, if you have questions about any part of this rule, or if you have questions regarding the new document that we're going to start using as of July 1st, feel free to give me a call at the office. 501-358-6131 is the number. I will be happy to review any part of this. If you're getting ready to recommend a rollover to a client and you need to complete the suitability form and you want to do it together for the first time or several times, feel free to set up an appointment with me to do that. I would be happy to. This new document is going to require lots of narrative information that you're going to have to fill in. And you can't use one-word answers or one-word descriptions or very simple descriptions. We have to have a clear understanding in writing of why it's in the client's best interest. And the document's going to ask you that in more than one way. So be prepared to invest some time anytime that you're going to work with a retirement client to move over an existing IRA or to roll over a qualified plan into an IRA, all of which that you're going to manage and work with this client. So let's jump into that. I think I've already covered this first slide. Some of these slides I'm just going to skip over because there's lots of words in them, and you can pause this video and read those words. There's no need for me to read them to you. So the new prohibited transaction exemption under ERISA and the Code for Investment Advice Fiduciaries with respect to employee plans, individual retirement accounts. So that's what's a little bit different than prior to this rule. Prior to this rule, if you were going to recommend a rollover from for example, 401k to an IRA, there was some disclosure that was required, and there was a form that we had you complete to go along with that application and request. Now, this rule has expanded from not only a qualified plan to an IRA, but also an IRA to an IRA. So if you want to be compensated for those account transaction types, you'll have to adhere to the requirements of the exemption, which is what we're fixing to discuss. The rule is designed to promote investment advice that is in the best interest of the retirement investors by mitigating conflicts of interest and ensuring retirement investors are receiving advice that is prudent and loyal. I pulled this language directly from the Department of Labor's fact sheet. Their whole goal and intention of this rule is so that the client clearly understands what their options are and what all comes with moving their account. For instance, the cost, what are they walking away from? Because there are some benefits to qualified plans that are not available in an IRA. We want to make sure that those benefits aren't of extreme value to the client, so that they can make a sound judgment by your recommendation whether or not it's a good idea to move their accounts. So relying on the exemption, you must document and disclose the specific reasons that any rollover recommendation is in the client's best interest. The form that we have created will prompt you to document and disclose all the required information. Another thing you must do is acknowledge fiduciary status in writing. That is also on this new document. Third, disclose the services and material conflicts of interest. That's also included in this new document. And lastly, adhere to impartial conduct standards, requiring adherence to 4 items. 1, investigate, evaluate investments. Provide advice and exercise sound judgment in the same way that knowledgeable and impartial professionals would. So backing up to the first few words of this, investigate and evaluate. The days where we just did what was best for our clients and acted upon them alone are over. In addition to that, we are going to have to show our work. Essentially, and I'm going to give an example here, which is just for example's sake. If you want to recommend a rollover to a client, and you're going to work with XYZ fund family, you need to show that you did your due diligence on that company and why you chose that company. You want to print out your fact sheets. You want to make notes. You looked at this company's growth fund versus that company's and other companies' growth funds. The Morningstar ratings were higher. The returns were better. The residents had overlap with the funds inside the funds inside each of the different funds of the fund company. There's a lot. You need to explain why you chose that company. It can't be, this is just what I've always used. This is what I'm most familiar with. You are really going to have to put some work in and create a file that it's a due diligence file of your investment recommendations. You can do this on the account level per account, or if you want, you can just have a due diligence file and keep all this information in that file. When we do a branch exam, we're going to ask for that file. And if the Department of Labor and perhaps other regulators examine the firm and for a branch, they may ask for it too. The rule specifically says investigate and evaluate. And if you don't have proof that you've done that, then they will assume it's not been done. Number 2, act with undivided loyalty to retirement investors and making recommendations. In other words, always put your interest ahead of your own. Number 3, charge no more than reasonable compensation and comply with federal securities law regarding best execution. So the first part of that, reasonable compensation. The fund companies and the insurance carriers set the compensation. At this point, we are accepting that as reasonable compensation. Some companies are levelizing compensation across the board between carriers and fund companies. And we've decided at this point not to do that as a firm. But as this continues to evolve and firms get fined or get slapped on the wrist for not complying in certain ways related to compensation, we may have to at some point reevaluate that. Now, on the advisory side, we have a tiered schedule for a tiered fee schedule based on assets under management. So if you stay within that tiered fee schedule, then you should fall into this reasonable compensation requirement. I shouldn't have to say this, but I will. You cannot charge the client more than that fee schedule. So if their assets brought in under management equal a certain dollar amount that falls under the 1.5% annual fee, you can't charge for that. Now you can discount your fees, but please document why you chose to discount the fees. You can't, because there will be a question at one point as to why you discounted this client and you didn't discount this other client. So documentation is very important, and that can all be documented on the advisory agreement. But as far as best execution goes, that only falls under the advisory firm at the moment, and we don't have a lot of control of where best execution. That falls under TD Ameritrade right now, and will be Schwab at some point. But we do review their best execution reports. Just ensure that we are getting best execution. These are reports that they have to file with regulators and public reports. So, but we do review that. Number 4, avoid making misleading statements about the investments in related relevant matters. I think this just comes down to being honest. We want to be clear, transparent, and honest with our clients. That's not anything new. There's a couple of things the firm's responsible for adopting policies and procedures. You can find the updated manuals under the at trutoro.com under the advisor login, and the password for that is VIP, all caps. When you go there, go into the document portal, scroll to the bottom where there's compliance documents are kept, and you'll see both the IA manual and the broker-dealer manual there. We're also required to conduct annual reviews related to PTE2022-02. So this is where we'll be asking for your due diligence file. So it's very important that you create one and have it available. So what triggers the requirement is your fiduciary status. And I will tell you, I am too. I will tell you that if you work with an investor, make a recommendation, they open an account and you're compensated, which is 99% of what the relationships look like with Trutoro, with Trutoro advisors and their clients, you're going to fall into this. So I've had some people ask, well, how do we get around this without using this? It's very difficult, it's almost impossible. But know that if the client is going to have an account and you're going to be listed as the advisor, you're going to get compensated to some degree, and you're going to have fiduciary status here. So in 1975, the Department of Labor issued a 5-part test for determining when a recommendation counts as investment advice, which falls under fiduciary status. 1 is rendering advice to a plan, the plan fiduciary or IRA owner as to the value of the security or other property, making recommendations as to the advisability of investing in, purchasing, or selling securities. And it says other property, that's because IRAs can own property like land, homes, commercial buildings, farms, etc. So that's why they're saying other property. It applies if that is on a regular basis, that advice, and we'll get into what regular basis means for them here in just a minute. And then it's pursuant to a mutual agreement arrangement. And here's the important word: understanding with plan fiduciary or IRA. If the client understands that there's a relationship, if you're going to open an account with the client, you're going to put funds into the account or transfer funds or rollover funds, they're going to be investing the way that you recommended to the client, that's considered an ongoing basis. The advice will serve as if the advice will serve as the primary basis for the investment. And lastly, the advice will be individualized based on the particular needs of the plan or the IRA. So this is where it talks about how is this considered an ongoing basis or regular basis. So advice to roll over a plan assets can occur as part of an ongoing relationship or at the beginning of an intended future ongoing relationship that an individual has with a financial professional. When the professional has been giving advice to the individual about investing in, purchasing, or selling securities through tax advantage retirement vehicles that are subject to ERISA or the code, the advice to roll over assets of the plan benefit plan is part of an ongoing advice relationship and satisfies regular basis. Now, that's a lot of words. So if you need to pause here and read this a couple of times, feel free to do so. But just know it is very difficult to get away from this requirement. It's almost impossible if you expect to have any type of relationship or receive any type of compensation from the client related to this activity. It's also considered to be on a regular basis when the investment professional, you, has not previously provided advice, but, and here I've underlined this, expects to regularly make investment recommendations regarding to the IRA as part of an ongoing relationship. So financial institutions, which is the firm, must acknowledge in writing their and your fiduciary status. Again, that's going to be included in this new document. It's part of the disclosure in the document. You must describe in writing the services to be provided. There's going to be a place on this form for you to explain what you're doing for this client. And the financial institutions and investment professionals' material conflicts of interest. Again, that's good. The conflicts of interest are disclosed in Form CRS. So you can see how these documents are going to complement each other moving forward. Firms must document the reason that the rollover recommendation is in the best interest of the client and provide that documentation to the investor. So once you complete this form that you're going to be filling out, you're going to need to give a copy of this to your client. You can email it to the client. You can print them a copy. You can print 2 copies when you meet with the client, have them sign both and give one to the client. However you want to achieve that, but you absolutely have to document the best interest and provide the document to the client. The impartial conduct standards have 3 components. One is the best interest standard, which we've discussed. We've discussed this multiple times over the last year and a half. The best interest standard is also related to Reg BI, reasonable compensation standard, and also make no misleading statements about the investment transactions or other relevant matters. These standards are consumer protection standards that ensure that financial institutions and advisors adhere to fiduciary norms and basic standards of fair dealing. The standards specifically require firms and advisors to, 1, give advice that is in the best interest of the client. The best interest standard has 2 components. That is loyalty and prudence. So I'll let you read below kind of a description of that. Number 2, charge no more than reasonable compensation. And number 3, no misleading statements. This, like I said before, there's a lot of redundancy here, but it's so important that we understand what's expected out of us when it comes to working with retirement investors. So, like I said in the beginning, it is prohibited to receive compensation from the recommendation of a rollover from an IRA to an IRA or a qualified plan to an IRA, unless you adhere to this exemption. This exemption has certain criteria that must be followed. So the answer to this question, I'm not going to read through this. You can pause it and read this if you'd like. But the answer is you can get paid for your advice, but only if you adhere to the requirements. This, I'm not going to also read through this. This is some more language that I pulled directly from the Department of Labor's Q&A page. If you want to read through this, you can pause the video and take a look at that. So when it comes to conflicts of interest, there's some things that the department wants us to be aware of. Before engaging in a transaction under the exemption, the firm must give its customer a written description of the firm and the advisor's conflicts of interest. Again, this is provided in Form CRS. Just a brief recap on Form CRS or the Reg BI documents, there's 3. When you make a recommendation to a client to roll over a 401k, that's the trigger to provide the client with those documents. Even if they're an existing client and you're going to recommend a rollover, that's a trigger. Another trigger is if the client is new to you. And then the last trigger is if it's an existing client that opens a new type of account. So for instance, they have an IRA account. Now they want to open up a joint account. That's a trigger. So there's 3 triggers to deliver those Reg BI documents to your client. And adhering to that adheres to this requirement of the DOL rule. The disclosures must be accurate, not misleading. Firms must disclose, for example, conflicts that might be related to proprietary products. We don't do that, so that's not applicable to us. Payments from third parties. We don't receive payments from third parties. And compensation arrangement for both the financial firm and the individual. So what factors should the firm and the advisor document in the disclosure of the reasons that a rollover is in the client's best interest? The financial institutions and advisors must consider and document their prudent analysis of why a rollover recommendation is in the best interest of the client. So consider and document. For recommendations to roll over assets from an employee benefit plan to an IRA, some factors that you should consider is what alternatives are there to the rollover, which may be leaving the assets at the current qualified plan with the former employer. It could be rolling those assets into the new employer's plan if that's permitted. So there's you can't just have the client come in and say, I want to work with you. Okay, client, here's your paperwork. Let's open an account and let's move the money over and we'll get started. You actually have to evaluate the current plan and ensure that there's no reason why the client wouldn't benefit from leaving it there or moving it to another qualified plan. The fees and expenses associated with both the plan and the IRA, there's almost never a situation where the client would move their qualified plan from where it is to an IRA and it not be more expensive. I know there are situations that can happen, but I've rarely seen that. So the client needs to understand they're going to pay more. And typically, if they've come to you, they understand that. Maybe they don't. So you have to disclose it to them. But typically, they're wanting your services, and they understand that your services come with a fee. Another thing to consider is whether the employer pays for some or all of the administrative expenses. So that's important. The different levels of service and investments available under the plan and the IRA. So most times there's a very limited universe of investment options at a qualified plan. But that may be all that the client needs. Maybe that's all the client wants. You really have to evaluate what they have, what the alternatives are, what other options are for where they're at, and document why what you're recommending is better for the client. Also, when considering alternatives to a rollover, the firm and the advisor should not focus on how the current allocation is invested. What's the current allocation of the qualified plan? Let me give you an example. If the client comes to you and they complete a risk tolerance test, which says that they're an aggressive investor, and your interview with the client shows that they want growth, but you look at their existing allocation in their qualified plan and it's all fixed income and money market. That obviously does not match up with the risk tolerance that you've discovered with the client. So, but you can't just say, okay, well, this doesn't match, let's move you over here to what would work for you, because that existing, because there are other options within that plan. There are probably growth options within that plan. And the client needs to understand that. This is what the Department of Labor wants you to make sure your client understands all of their options. And one option may be to reallocate within the qualified plan. For rollovers from another IRA or from like an advisory account, a fee-based account, a recommendation would include consideration and documentation. Again, there's that word, it's so important, of the services under the new arrangement. So things that are relevant that you should include are increased cost, why the rollover is appropriate, and the impact of economically significant investment features such as surrender schedules with annuities or caps and participation rates on indexed annuities. The client needs to be made aware of all of these things. I'm not going to read through this. You can pause it if you'd like to. Again, this is language pulled directly from the Department of Labor's website. Now, one thing I don't think I've said, and I want to make sure that you are aware of, in the past, if you've had a difficult time getting information related to the client's current plan, such as the cost, available investment options, and etc., just putting on the sheet unavailable, couldn't obtain, client doesn't know, is not acceptable anymore. You have to make a diligent effort to get that information. Your client's probably not going to know it. Sometimes they do. Sometimes they are very aware of everything related to their 401k or the qualified plan. But if they are not, you need to get on the phone with the client and put your best effort into getting that information, either documenting it through the phone call and make sure that you document that's how you receive the information, have them email it to the client and have the client forward that to you so you can print it and include it with the disclosure document. If you can't get that information that way, a lot of this information is available on the web. And as it says down here, so you could rely on alternative. Oops. I wish I could know how to go back. Oh, there we go. Rely on alternative sources such as Form 5500 or reliable benchmarks on critical fees and expenses. If every suitability form you send to me says unavailable, this is what I found on the web, it's going to be obvious that you're not, you know, if you send me 20 in the year and all 20 of them have, you know, information unavailable, client doesn't know, found this on the web, it's going to seem like you're not really putting a lot of effort. That's not going to be me saying that. That's going to be whoever's auditing that file from a regulatory some department. So please do your best due diligence to find this information. I'm not going to go into this either because this is really what the firm is going to be doing related to the reviews, but just know that we are required annually to do a review, and we will probably be reaching out to some of you and saying, please submit me your due diligence file related to a particular rollover request. So make sure that you've got those available for us. Okay, that's the end of the slideshow. Let's see. Let me go back. Now I'm going to pull up the document. Let's see. Here we go. Nope. Here we go. All right. The rollover suitability questionnaire this is the new rollover form. So we're going to pull down the old rollover form off our website. I'm going to include this document in this email with the link to this video. If you have any questions or concerns about any of this information, please give me a call. Like I said at the beginning of the video, I'll be glad to walk you through this. It's going to be tricky and hard, and words could be hard to come up with. But just imagine yourself trying to defend your reason to a regulator of why you thought this was in the best interest. If they're saying to you, okay, advisor, tell me why you thought this was in the client's best interest. Those are the words you're going to document on paper here. And these questions should help lead you to the right answer. So we talked about fiduciary acknowledgement. That's in the first or the second section here of this document. You can read through that. We're just giving acknowledgement like we're required to do. The best interest standard is going to follow here. You can see, change of employment, retirement. You can check all that apply. If the answer is other, put a narrative description in this box. Here, the client's reason for the rollover transfer. Up here, we're talking about the reason for the rollover. There's very much overlap in that question. There's a little bit of a difference though. You can see by these questions that are here. This section, the current portfolio. Describe how the retirement assets are currently invested. Also attach a copy or printout of the statement, or sometimes the client doesn't get a statement, it's in the portal. So be sure and attach that to this because we'll need to see it. You've got to have it in order to make the recommendation. You can't make a blind recommendation not knowing at all what the client currently has in their plan. That might have been something we could do in the past. It is not acceptable moving forward. So we need to know. You can also in this area describe what other options they have available. So in my example earlier with a client that had an aggressive risk tolerance, but a conservative portfolio with the plan. And I said, we have to, department tells us we have to see what other investments are available to that client, because the client needs to understand that they could just stay where they are and reallocate. I know that sounds backwards from the way we operate, but that's what we're being told we have to do. So you can explain that in this section also. So here, summarize the recommendation and address the services that will be provided. Addressing the services, that was another part of the requirement that will be provided in the box below. That could be quarterly rebalancing, annual reviews with the client, just anything that you're going to provide as a service related to this, you're going to want to put in here along with the recommendation. If you have a nice proposal you want to give the client, attach it to this so that we can include it in the suitability form. Also here, you're going to summarize these other things, A, B, C, and D. Alternatives to the rollover. Whether or not the IRA rollover account will generate higher or lower fees. So this is where you're going to say the current plan is 75 basis points. With the proposed plan, there's going to say for instance, it's an advisory account. There'll be internal fees, and you could give a range from 25 basis points to 1.25%. In addition to that, there's going to be a 1% management fee. Whatever the situation is, you have to get on the granular level of the cost for the client. The other thing is whether the employer pays for some or all of the cost related to the plan's expenses. Lastly, comparison of different levels of services investments available under the plan versus the proposed new account. You're essentially saying, this is what they've got, and these are all the details. This is what I proposed, and this is all the details. And you probably will want, again, to attach more if there's not enough room here. If you're handwriting this, you can definitely go outside the box. But if you're typing it and run out of room, please just attach another sheet. Have you advised the client to discuss the following tax considerations? You probably should always, that should just be a standard comment. You know, you might want to check with your tax professional regarding this, but there are a lot of, there are very few situations where this rolling over an IRA is a taxable event. So you can also say that to your client. Does the plan participant, excuse me, need to make sure that they're not giving up penalty-free withdrawals if that's something that you think could be important to the client as you discover through your due diligence process in evaluating the client? Does the client intend to work past age 72? Well, if they do, you need to make sure they're aware that they can postpone those RMDs while they're working. C, are there negative tax implications, etc.? So answer those questions. This box, document your rationale as to why this rollover recommendation is in the client's best interest, taking into consideration the above information. And that means everything above. Why is this in the client's best interest to move over? There are going to be times when it might not be in the client's best interest, but keep in mind why the client came to you to begin with. You know, if they're truly wanting guidance, if they're feeling neglected, like they don't have the help and support that they need from their plan, if they've left employment, sometimes the employer requires them to roll out a transfer, or they're going to send a check to them for the balance of their account because it's a smaller balance. Whatever the situation, you need to make a really good case as to why it's in the client's best interest to roll over that qualified plan. So document the reasons why the investment recommendations. So up here, we're saying, why is the rollover in the client's best interest? Here, you're going to document why your investment recommendations are in the best interest of the client. Number 2, impartial conduct standards. So there's a box here. I'm going to delete that. That doesn't belong here. The second impartial conduct standard mandates that advisors receive reasonable compensation for their services. Reasonable means the compensation cannot be excessive and does not mandate that compensation be the lowest. Compensation must be judged in the context of the services provided. So this is where we're disclosing reasonable compensation to the client. Justify how the compensation for the recommendations is reasonable in light of the proposed services. Essentially, this is where you're going to tell the client what all you're going to do for them. This is why they're paying for your services. You're going to list those things out to them again. Be careful here to not make promises you can't keep either. And you can also put this on your client to some degree. So if you're telling the client, I'm going to rebalance on average quarterly, depending on the circumstances of the market, you and I are going to have at least a phone call, in-depth phone call to review your account annually, or we're going to have a sit-down meeting annually. Whatever you say you're going to do here, make sure that you do it. But then you can also tell your client, if you haven't heard from me and you have questions or concerns about your account, please pick up the phone. I know that goes without saying, but I think sometimes, especially as we grow our business, we can forget to take care of things like that, or clients can seem neglected because you're so busy, and putting a little bit of that on their shoulders is totally acceptable. But we want to make sure that we're able to fulfill the promises that we make to our client. And if we're putting them in writing, which we're being forced to at this point, then you want to make sure that you take care of that. So here the client, the advisor is signing, saying that you've given the client a copy of this and a copy of Form CRS. Here the client is signing that they've received a copy of this and for Form CRS, and then submit this for review. I know that's a lot of information to cover, and I've covered it rather quickly. So again, if you have questions, if you have concerns, if you just want to just bank this information, and then when you're ready to do a rollover or transfer to an IRA, give me a call and I can do a one-on-one review with you at this again. If you've met with a client and you're getting ready to sit down with the proposal part of your relationship and you want to go over the language that you intend, you can completely fill this out and review it with me prior to even sitting down with a client for the client's review. Feel free to do that also. All right, if you have any questions, give me a call.